They say, history doesn't repeat itself, but in crypto, it often rhymes. Welcome. I am here to expose the forgotten stories that built this industry. So sit back and watch closely. If you walked into a bank, wrote a number on a napkin, and handed it to the teller, they would immediately hand you that amount in cash. No credit check, no collateral, no questions asked. Now imagine that bank is actually a digital exchange handling billions of dollars of other people's life savings, and the person writing on the napkin isn't a customer, but the owner of the bank himself. This sounds like a clumsy cartoon villain plot, the kind that would be laughed out of a writer's room for being too unbelievable. This is exactly the mathematical reality of what happened at FTX. We are not talking about a simple case of embezzlement or a CEO dipping into the till. We are looking at a complex, systemic engine designed to extract value from retail investors and funnel into a black hole of bad bets and political donations. While the media was busy fawning over a disheveled genius playing video games during pitch meetings, the balance sheet told a very different, very horrifying story. It is a story of leverage liquidity illusions and the most expensive accounting error in the history of finance. But to understand how a 30-year-old lost $32 billion in less than a week, you have to look past the afro and the cargo shorts. You have to look at the math. Sam Bankman-Fried cultivated an image that was meticulously crafted to disarm you. He was the anti-Wall Street billionaire. He drove a Toyota Corolla. He slept on a beanbag chair, and he preached the gospel of effective altruism. The narrative was perfect. Here was a man who wanted to make as much money as possible, not to buy yachts or islands, but to give it all away to save humanity. This shield of morality blinded the smartest people in the room. Venture capital giants like Sequoia and BlackRock pour hundreds of millions into FTX without demanding a seat on the board or proper oversight. They saw the rapid growth, the celebrity endorsements from Tom Brady to Larry David, and the skyrocketing valuation, and they assumed the financials were rock solid. They assumed that a company processing this much volume must be a fortress of solvency. But this is where the retail investor and the institutional giants made the same fatal mistake. They confused revenue with reliability. They looked at the shiny user interface of the FTX exchange and assumed it was a vault. In reality, it was a piggy bank with a hole in the bottom. While everyone was debating Sam's philosophy or his political contributions, nobody noticed that the architecture of the exchange itself was fundamentally broken. The entire empire was built on a lie, but it wasn't just a verbal lie. It was hard-coded into the system. And while the world was distracted by the magazine covers, a single, secret change to the software's codebase had already sealed their fate. To understand the mechanics of the theft, we have to talk about the relationship between FTX and Alameda Research. FTX was the exchange, the public face where you and I would deposit our Bitcoin or Ethereum to trade. Alameda Research was a quantitative trading firm, a hedge fund started by Sam before he built the exchange. In theory, and in the public statement Sam made to Congress, these two entities were completely separate. A firewall existed between them. Alameda was just another customer on the FTX platform, playing by the same rules as everyone else. If Alameda made a bad trade and lost money, the system should have automatically liquidated their assets to protect the exchange, just like it would for you or me. That is how a margin engine works. It is cold, mathematical, and impartial. But inside the FTX database, there was a specific setting, a flag in the code that applied only to Alameda. It was called allow negative. This innocent-looking command effectively disabled the auto-liquidation protocol for Alameda's main account. It meant that no matter how much money Alameda lost, no matter how deep into the red their balance went, the system would not close their positions. It gave them a God mode cheat code in a multiplayer game. This allowed Alameda to borrow effectively unlimited amount of capital from the FTX customer deposits. When you deposited $1,000 onto FTX, you thought it was sitting in a digital vault. In reality, Alameda was pulling out the back door to gamble on obscure altcoins and illiquid venture capital deals. But simply having a credit line wasn't enough. To borrow billions, you generally need to show billions in assets. You need collateral. And since Alameda had burned through much of its actual cash, Sam needed to invent a new form of value. He needed to create money out of thin air, and he did it with a token that would become the centerpiece of his financial house of cards. Enter the FTT token. This was the native cryptocurrency of the FTX exchange. On paper, it was a utility token. If you held it, you got discounts on trading fees. It is a standard model in the crypto industry, similar to airline miles or credit card points. But in the hands of Sam Bankman-Fried, FTT became something much more dangerous. It became the engine of a recursive loop of leverage. Here's how the math worked. FTX created the FTT token. They kept the vast majority of the supply for themselves and released a tiny fraction to the public. Because the floating supply, the amount actually available to trade, was so small, it was incredibly easy to manipulate the price. With just a little bit of buying pressure, the price of FTT would skyrocket. Once the price was high, Sam could point to the billions of FTT tokens sitting on his balance sheet and say, "Look at all these assets we have. Look at how solvent we are." Alameda would then use this inflated FTT as collateral to borrow real customer assets, Bitcoin, stablecoins, real dollars from FTX. It was the ultimate financial alchemy. They printed a token, pumped its price, and then used it to take out loans against your deposits. It is equivalent to me drawing a picture of $1 million bill on a piece of paper, valuing it at $1 million because I refuse to sell it, and then using it as collateral to take a mortgage out on your house. As long as the price of FTT remained high, the math worked. The balance sheet looked healthy. The auditors, if there had been any competent ones, might have just seen assets exceeding liabilities. But this entire structure relied on one crucial variable, liquidity. If everyone tried to sell their FTT at once, the price wouldn't just dip. It would collapse to zero because there were no real buyers for that amount of tokens. It was a ticking time bomb disguised as a blue-chip asset. And on November 2nd, the fuse was lit by a leaked balance sheet that revealed the terrifying truth. The emperor wasn't just naked, he was insolvent. The catalyst was a report from CoinDesk. They had obtained a private financial document from Alameda Research, and the numbers were staggering in the worst possible way. The report showed that out of nearly $15 billion in assets on Alameda's balance sheet, a massive chunk was just FTT tokens and other Sam coins, low liquidity tokens that Sam had backed, like Serum and MAPS. The report laid bare the circular dependency. Alameda rested on the foundation of FTT, and FTT rested on the confidence in FTX. If that confidence broke, the cycle would reverse. This report caught the eye of the one man Sam cannot charm or manipulate, Changpeng Zhao, or CZ, the CEO of Binance. CZ and Sam had a complicated history, but business is business. CZ looked at the math, saw the illiquidity of the collateral, and made a ruthless, rational decision. He tweeted that Binance would liquidate his entire holding of FTT tokens. This was the emperor's new clothes moment. The market realized instantly that if Binance started selling, the price of FTT would crash. And if FTT crashed, Alameda's collateral would be worthless. And if Alameda's collateral was worthless, they couldn't repay the billions they had borrowed from FTX. Panic set in immediately. This wasn't just a price drop. It was a bank run. Customers rushed to withdraw their funds. In the traditional banking world, a bank run is dangerous but manageable because the government insures deposits. In crypto, there is no bailout. FTX saw withdrawals hit billions of dollars in a matter of hours. As the withdrawal requests piled up, the internal dashboard at FTX lit up with red warnings. This is the moment where the allow negative feature in the FTT flywheel collided with reality. Customers were asking for their Bitcoin, their Ether, and their Solana, but the wallets were empty. The assets weren't there because they had been lent to Alameda, and Alameda had lost them or locked them up in illiquid private equity deals. We are talking about an $8 billion hole in the balance sheet. Sam tried to scramble. He went on Twitter claiming FTX is fine. Assets are fine. He tried to raise emergency capital from Wall Street, from Saudi investors, even from CZ himself. But anyone who looked at the data room ran for the hills. The due diligence took minutes because the fraud was so apparent once the curtain was pulled back. There was no segregation of funds. There was no risk management. There was just a spreadsheet held together by hope and deceit. The math of the fraud was simple. Customer deposits minus Alameda, losses equal zero. When the dust settled, FTX filed for Chapter 11 bankruptcy. The smart money that had invested in Sam was wiped out. The retail investors who trusted the altruist lost their savings. It was a brutal lesson in the difference between mark-to-market accounting and actual realizable value. The collapse of FTX wasn't just a failure of a company. It was a failure of due diligence on a global scale. It exposed how easily sophisticated investors can be duped by a good narrative and a rising chart. Sam Bankman-Fried didn't use complex derivatives or high-frequency trading algorithms to steal the money. He used a back-end loophole and a token he printed himself. It is a reminder that in the world of finance, complexity often masks criminality. The smartest guys in the room aren't the ones on the magazine covers. They're the ones reading the footnotes in the audit reports. The lesson here is brutal but necessary. If you don't understand where the yield is coming from, you are the yield. If the collateral is a token created by the borrower, the value is zero. And if the CEO tells you to trust him, that is the exact moment you should verify everything. FTX is gone, but the mechanics of this fraud, rehypothecation, commingling of funds and token manipulation are not new, and they certainly aren't extinct. The market has cleansed itself of one bad actor. Yet the incentives that created Sam Bankman-Fried still exist today. If you want to survive the next cycle, you need to stop thinking like a fan and start thinking like an auditor. You need to look at on-chain data, not Twitter threads. The smart money is already positioning itself for the next narrative, and they are betting that the retail crowd has a short memory. Don't prove them right. We're going to dive deeper into the specific on-chain signals that predicted this collapse months in advance in our next video. And I'll show you how a similar pattern is forming in another major stablecoin right now. You cannot afford to miss that breakdown. Subscribe so you're notified the second it goes live.